With markets swinging on headlines from geopolitics to AI disruption, how can advisors help clients find the long-term opportunities amidst the short-term noise? Hi, I'm Matt Wrzesniewsky. In this video, I'll share how Vanguard fixed income is approaching today's volatility by focusing less on macro predictions and more on what we can confidently underwrite. There's no shortage of macro narratives right now. Geopolitics, AI disruption, policy uncertainty, and advisors are hearing all of them from clients. Our approach hasn't been to predict those outcomes, but to be focused on them at the security level in active fixed income portfolios, where we could assess downside, understand structure, model out cash flow durability that's independent of any macro forecast. What tends to get lost during volatile periods is that volatility just doesn't increase risk, it increases dispersion. And dispersion is where disciplined security selection really matters. In the market today, we're beginning to see spreads widen modestly, which gives us the opportunity to re-underwrite positions based upon fundamentals rather than respond to headlines. So the takeaway, you don't need to have a strong macro view to add value in an environment like this. Staying anchored to process, being laser focused on fundamentals and diversification have historically mattered more than getting the macro exactly right. When we look across credit markets, high yield, bank loans, and even private credit, the differences today are less about labels and more about underwriting discipline in the post-COVID period. History doesn't repeat itself, but in the bond market, it often rhymes, and following where capital has flowed is critical. Over the past several years, we've seen growth in private credit and even in bank loans, and this is often tied to private equity-backed transactions. Now, much of that risk historically would have lived in the public high-yield market, and the shift is where marginal risk is being held has very important implications for transparency, liquidity, and how stress ultimately shows up within credit markets. We're beginning to see some of those underwriting decisions season. Now, credit cycles, they take time, and as conditions normalize, the consequences of leverage, structure, and covenant quality are becoming more clear. For financial advisors, the key question isn't about public versus private. It's about how deals were underwritten and what protections exist and how resilient the cash flows are under stress. So at the same time, increased dispersion can create opportunity for disciplined managers and improve the entry point and risk-adjusted outcomes. For us, geopolitics are often a fundamental question of time and transmission. Markets tend to absorb these events unless they translate into something that's more structural, such as a prolonged disruption in global energy supply, a sustained tightening in financial conditions, or even a global recession. But what's important for advisors is separating headline risk from portfolio risk. For example, most diversified portfolios have little to no direct exposure to Iran due to long-standing sanctions and index construction. Any impact is typically indirect, working through energy prices, inflation expectations, and policy responses, rather than company-specific exposure. Historically, equity and credit markets have tended to recover once uncertainty fades, even when geopolitical situations remain unresolved. From a portfolio standpoint, this environment is less about making tactical shifts and more about reassessing assumptions and re-underwriting positions, reinforcing the role of high-quality fixed income as a stabilizer. While near-term volatility may persist, the broader investment backdrop remains driven by fundamentals like growth, inflation, and monetary policy. Periods like this can feel uncomfortable, but they're not unusual. Markets have historically navigated geopolitical shocks and credit cycles many times before, and advisors who maintain perspective, stay disciplined, and keep portfolios diversified have historically been well-positioned to manage uncertainty and participate in long-term outcomes. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.